In the spring of 2021, a series of frantic phone calls between Wall Street executives erased more than $10.0 billion from the global financial system in a matter of days. The massive losses did not stem from a global pandemic, a housing market collapse, or a complex cyber attack. Instead, the unprecedented wealth destruction originated from a single, relatively unknown family office operating out of Manhattan. This quiet implosion revealed a hidden network of extreme leverage that connected one investor to the balance sheets of the world's most powerful financial institutions. At the center of this financial crater was Bill Hwang, a former hedge fund manager who had quietly amassed a staggering fortune through his private firm, Archegos Capital. Because the firm managed only his personal wealth, it was classified as a family office, a designation that shielded it from the rigorous oversight typically applied to traditional hedge funds. Operating in this regulatory gray area, Hwang adopted an incredibly aggressive investment strategy. He focused on a highly concentrated portfolio of media and technology stocks, aiming to magnify his returns through borrowed money. To achieve this massive scale, without triggering public disclosure requirements, Archegos utilized complex financial instruments known as total return swaps. In a standard stock purchase, an investor buys shares directly and assumes ownership. With a total return swap, a bank buys the underlying asset and agrees to pay the investor any profits that the stock generates, while the investor agrees to cover any losses. This synthetic arrangement allowed the firm to gain massive exposure to price movements without ever officially owning the underlying shares. The global banking sector eagerly facilitated this strategy because of the immense financial incentives tied to prime brokerage services. Major institutions like Credit Suisse, Nomura, Morgan Stanley, and Goldman Sachs competed aggressively for Hwang's business. In exchange for executing his trades and lending him billions of dollars, these banks collected lucrative fees and steady commissions. The prime brokerage divisions viewed Archegos as a highly profitable client, creating a powerful economic motivation to accommodate his increasingly large requests for leverage. The fundamental vulnerability of this arrangement lay in the fragmented nature of the banking system. Archegos executed these swap agreements simultaneously across multiple financial institutions, effectively walling off information. None of the prime brokers knew exactly how much leverage the others were extending to Hwang. This extreme siloing of data meant that each bank assessed its own risk based on an incomplete picture, unaware that their client was building a precarious mountain of debt across Wall Street. By relying exclusively on swaps, the firm legally sidestepped the Securities and Exchange Commission mandate, requiring large investors to publicly report their holdings through 13F filings. If Hwang had purchased the stocks directly, his massive positions would have been visible to the entire market, including the risk managers at his lending banks. Instead, the actual shares sat on the balance sheets of the banks themselves, masking the true concentration of risk tied to a single individual. The illusion of safety was further compounded by the collateral arrangements between the family office and its lenders. Banks require clients to post cash or securities as collateral when utilizing leverage, ensuring there is a buffer if trades go poorly. However, because multiple banks were unknowingly lending against the exact same highly concentrated stock positions, the perceived safety net was entirely synthetic. If those specific stock prices fell, the collateral value across all the banks would evaporate simultaneously. Throughout late 2020 and early 2021, the continuous flow of borrowed money into a handful of specific companies artificially inflated their market value. As Archegos directed its brokers to buy more shares to hedge their swap exposures, the immense buying pressure drove prices higher. This upward momentum created a self-fulfilling cycle, generating paper profits for the firm, which were then used as collateral to borrow even more money and initiate even larger swap positions. The broader market remained entirely oblivious to the fact that a single entity was functioning as the primary engine behind the soaring valuations of companies like Viacom, CBS, and Discovery. This lack of transparency highlights a critical flaw in modern market structure, where synthetic derivatives can distort price discovery. The underlying value of these corporations had not fundamentally changed, yet their stock prices had doubled or tripled, based almost entirely on highly leveraged, concentrated buying. The fragile equilibrium shattered in late March of 2021, when Viacom CBS attempted to capitalize on its surging stock price by issuing new shares to the public. The market rejected the offering, causing the stock price to drop sharply. This sudden decline in value immediately impacted the total return swaps held by Archegos, transforming massive paper profits into devastating real-world losses in a matter of hours. The underlying collateral supporting billions of dollars in loans was suddenly insufficient. As the value of the underlying stocks plummeted, the prime brokers initiated margin calls, demanding that Huang deposit additional cash to cover the rapidly expanding shortfall. The family office, having exhausted its liquidity to maintain its highly leveraged positions, was unable to meet these demands. This failure to produce cash triggered a contractual right for the banks to seize the underlying collateral and liquidate the stock positions to protect themselves from further losses. The realization that Archegos was defaulting forced the major banks into a high-stakes prisoner's dilemma. The risk executives at Goldman Sachs, Morgan Stanley, Credit Suisse, and Nomura quickly recognized that they all held massive blocks of the exact same stocks. If they all tried to sell simultaneously, the sheer volume of shares flooding the market would crash the prices further, guaranteeing catastrophic losses for everyone involved. They briefly attempted to coordinate an orderly unwinding of the positions. The attempt at cooperation collapsed almost instantly as the instinct for self-preservation took over. Goldman Sachs and Morgan Stanley moved first, quietly accelerating their selling and offloading billions of dollars worth of stock before the broader market fully understood what was happening. This aggressive, preemptive liquidation protected their balance sheets, but sparked a brutal 2021 market crash in the specific media and technology sectors where Huang had concentrated his bets. The banks that hesitated were left holding the resulting wreckage. Credit Suisse and Nomura, attempting to manage the fallout more deliberately, found themselves trying to sell shares into a market that was already in freefall. Because they waited just a few hours longer than their competitors, the value of the collateral they held had been virtually wiped out. The delay transformed what could have been a manageable loss into an existential threat to their prime brokerage divisions. The final accounting of this chaotic unwinding revealed the devastating power of unseen leverage. Credit Suisse absorbed a staggering $5.5 billion hit, a blow so severe it fundamentally destabilized the historic institution and contributed to its eventual collapse. Nomura lost nearly $3.0 billion, while other lenders absorbed the rest. In total, the banking sector lost over $10.0 billion, all originating from the default of a single client they had aggressively courted. The systemic vulnerabilities from that era persisted long after the immediate panic subsided. The collapse demonstrated that the regulatory exemption for family offices was based on an outdated assumption. Regulators had historically assumed that because family offices managed personal wealth, their failure would only harm the individual. Archegos proved that when personal wealth is amplified by billions of dollars in bank leverage, a private failure becomes a systemic banking crisis. The incident exposed a glaring gap in the oversight of global financial markets. While banks are strictly regulated on how much risk they can take, the derivatives market allowed them to outsource that risk to an unregulated entity. The total return swaps functioned as a backdoor, enabling financial institutions to generate massive fees while technically remaining compliant with capital requirements. The regulatory framework had failed to keep pace with the complexity of modern financial engineering. Beyond regulatory shortcomings, the event highlighted a profound failure in corporate governance and risk management within the banks themselves. The pursuit of prime brokerage commissions had systematically blinded risk committees to the obvious dangers of extreme concentration. The internal systems designed to prevent catastrophic losses were overridden by the lucrative revenue streams generated by a single, highly active client. The incentive structure within the banks rewarded short-term profits over long-term stability. This disaster forces a re-evaluation of how liquidity is perceived in modern markets. The daily trading volume of the affected stocks created a false sense of security for the risk managers. They assumed they could easily sell the shares if necessary. However, they failed to account for the fact that a significant portion of that daily volume was being generated by their own client. When the client stopped buying, the perceived liquidity simply vanished. When financial institutions prioritize aggressive fee generation over prudent risk management, the consequences inevitably spill over into the broader economy. While the immediate losses were borne by bank shareholders, the resulting tightening of credit and the destabilization of major financial institutions have far-reaching effects. The capital that was destroyed in a matter of days could have been deployed to fund actual economic growth, rather than evaporating in a failed wager on synthetic stock derivatives. The collapse of Archegos Capital Management was not merely the result of one man's reckless gamble, but rather the predictable outcome of a financial system eager to look the other way. The banks possessed all the tools necessary to understand the risk, but the economic incentives discouraged them from asking the right questions. It serves as a stark reminder that leverage does not create value. It only accelerates the consequences of our decisions. Because understanding why it happened is the best way to recognize it happening again. If you enjoy breaking down the incentives, decisions, and systems behind corporate scandals, not just the headlines, subscribe for new investigations every week, because understanding why it happened is the best way to recognize it happening again.